Foot Locker shares sinking into the red, closing off 28%. The company is slashing its annual guidance for the second time. Foot Locker also announcing it will suspend its cash dividends beyond a recently approved payout slated for October. The bad news keeps piling up here, Diane, for Foot Locker. A very, very challenging couple of quarters possibly ahead. Theft, markdowns, hurting profits, sales falling nearly 10%, pausing their cash dividend. I think investors are really questioning what it's going to take to turn around this business.
It's a good question. I mean, we saw Foot Locker previously guide lower for their expectations for sales, for comps, and now expecting an even bigger, pardon the pun, shoe to drop there. Sorry, it just came out. I mean, they've slashed their full year outlook for earnings down to a range of $1.30 to $1.50. They previously guided for between $2 and $2.25, $2.25 there. So, just the call outs also about the price sensitive consumer. Foot Locker CEO Mary Dillon saying that in the company's earnings release. I mean, and just the worries about the consumer and the discretionary dollars and where they're spending them. And right now, Foot Locker feeling the effect of people choosing to spend their dollars on experiences, and they still haven't seen a strength with back to school season. Like some retailers have seen some strength there, but some, again, all the retailers in general that we've seen have, though, talked about worries about the consumer. Some are managing to avert those issues, but Foot Locker not doing so well here. All right, another stock we're looking at, Williams-Sonoma, out with an earnings beat. The company also raises its operating margin outlook for the year. The stock finishing up more than 13%, about 13.5% on the day. This boost in margin guidance offsetting the company's reduction in its revenue outlook. So, its margins look good. They were stronger than what was expected. They may have had some sales declines, but, Williams-Sonoma held up. If people don't remember some of their brands, they also own Pottery Barn. I think West Elm is in their belt, too. So it looks like management has done well in terms of managing their margins. Shauna.
Yeah, they've done okay. It's certainly a challenging time here for Williams-Sonoma. You take into account some of their brand names that you were just mentioning there. West Elm there was weakness during the quarter. Sales off 20.8%. That was much more than the street was looking for or expecting. They were expecting a drop of 13%. Also, Pottery Barn, comp sales there declining over 10%. The estimate was for a drop of just about 5%. So yes, the focus here and the reason why we're seeing gains during the day today was because of the fact that it did boost its full year operating margin forecast. That was enough to excite the street, especially since investors were bracing for a cut. But it is still a very challenging couple of months likely ahead for Williams-Sonoma and also a number of the names within that sector. And bared out saying that they do have a strong balance sheet, which does provide a capital allocation optionality. So it enables them to weather what's likely going to be a tough couple of months, but still consumers pulling back on discretionary spending. We've seen that pretty much across the board from the retailers. It's going to set up some of these retailers to have a tough couple
end
of months.
Year. Yeah.
All right, let's take a look at Netflix getting a boost after data from research firm Antenna showing that U.S. subscriber additions in July remaining high. This coming after an initial surge in subscribers following the start of the password sharing crackdown back in May. We're looking at gains of just about 3.5%, the fourth day in a row that we've seen Netflix close the day higher. Oppenheimer reaffirming its outperform rating on the stock, $515 price target. They call out two tailwinds here, paid sharing and also advertising initiatives. Those two initiatives, they see boosting revenue by 40% for the fiscal year 2023 compared to what we saw back in 2022.
Yeah, it's really interesting to see that, just the expectation and Netflix doing better than expected in terms of the implementation of that password crackdown, not seeing the churn that we expected, and not seeing just general churn in terms of streamers. I mean, Netflix continues to be the leader in that respect. Even if you think back to once upon a time, they had that quote, love is sharing a password. Apparently it's not now. But again, Oppenheimer pointing out just that they expect to see this revenue increase and that the drivers are being underappreciated by investors today, definitely being appreciated by investors in terms of where the share price is right now.
Yep, up just about 3.5%.